Hey everybody, this is Carolyn at KiwiTrader24 from Twitter, and this is a quick video talking about the S&P 500 as we move into December week 3, the Fed and quarterly rebalancing of the indices, which is happening on Friday at the end of the day. So expect some volatility and some high volume from whatever spot we land by the time we get into trading next Friday. I run a private account at Kiwi24 Carolyn by donation, and there's a link in my profile here on my public account. If you're interested in following me over there, you just make a donation, and then you hear my tweets all day long. And I have a blog, and I have a whole set of videos and things like that. And I talk much more in depth about targets for next year and all that good stuff. So if you're interested in working together with me, I do a lot of one-on-one work with people over there. Just like I said, go ahead and click the link. But in the meantime, just wanted to give back a little something here and talk about the S&P 500 in a video for you guys as we start week 3 trading. So as we came into the week, this is a close-up version of a simplified S&P 500 chart that I share with people over at my private account. I share it with you guys too. Every once in a while I post it to my public account as well. So this is the S&P 500 stripped away of all the details and just focusing on the simple moving averages and these gaps and so forth. So we had a death cross that happened here more towards the beginning of the month, right around the G20. We traded up and over it, and if we had followed through on the rally, that would have clearly been an effort to combat the coming death cross. But we failed miserably right at 2,800. They wouldn't even print a 2801 on that rally that we came into after the G20. And we rolled over, and of course this death cross threaded through. And now the now the 200-day simple moving average is sort of beginning to fall as well. So it really and truly is a death cross. It was sort of a mini death cross because the 200-day line was sort of flat to still rising occasionally. And now it is descending as well, so it is a true death cross. And then as we came into the day here on Thursday of this past week, we had the 10-day and the 20-day beginning to meet and cross each other, both falling lines. And then on Friday, of course, we opened in a big sell signal, and that did indeed come to fruition. Now, I'm not saying that it's because the simple moving average lines cross, but the simple moving average lines represent closing prices of time periods. And the time period of the 10-day simple moving average is about 2 weeks of trading, and the 20-day is about 1 month of trading. So the average closing price of the last 2 weeks fell down through an already falling 1 month average closing price, and that sends off programming messages to the algos, and they sell. They do not buy, they sell. Plus, we are already in this death cross as it is with the 50 and the 200-day. We left a nice big brand new gap here that we'll have to trade back and close up at some point in time at 26.50. We broke down and made a new closing low below 26.32. That had been our previous closing low that happened all the way back here at Black Friday on November 23rd. And no matter what we did, even on this day this week when we flushed down to 25.83, we still rallied back and closed above that 26.32 level. Well, on Friday, we opened up and we couldn't even put in a good flat intraday with 5-minute candles closing in a row. Couldn't even do that above this 26.32 level, and we sold off from there. So we have a fresh new closing low for the quarter, for the month, and for this period of the sell-off since we've made the all-time high. Our previous closing low had been this 26.32. Now it is 25.99.95, the close on Friday. The closing low for all of 2018 was set back in February at 25.81. So if we trade down and trade down on Monday, but come back and close at least above 25.81, and you're wondering what the hell's going on? Why do we keep closing above this 25.81 level? It's because that is our closing low of 2018, and there is an effort being made to hold that securely. If we make a close down below 25.81, that's a brand new closing low for the year, and I would be very much inclined to say that means we are going to probably break that 25.32 level and sell off further. One thing that might save us, and this is just kind of a funny thing here, I don't really place a lot of reliance on angled lines, on trend lines. Trend lines are so subjective; they completely rely on where you set the points at. But there is a pretty compelling one here, and let's just see if it works out. If we were to draw a line down from the January high on through this on through this October low, the initial low of the sell-off at 2603, and let that just fall on through. And then if we were to put another line on the all-time high and put it through this high that we failed at right after the G20 meeting, maybe we could say that we have a falling wedge pattern here. And if we were to go ahead and meet that falling wedge on Monday and trade down to 25.55 and reverse off of there, that would be holding the bottom of this falling wedge. And the falling wedge pattern is a bullish one because it's a bullish pattern when we obey and hold the bottom of it. If we do not obey and hold the bottom of it, it becomes an actual falling channel instead, and the line does this. And the line becomes parallel with the top of the wedge instead. So that's the reason why the falling wedge can be such a bullish pattern, because it really represents a line in the sand between success and disaster. And it's a very popular one that, you know, in terms of when there were more people and less algos involved in trading, really traded these patterns and relied on them as actually holding. So if we were to actually hold that one on Monday at 25.55, on Tuesday it starts to drift even lower. That would do this. When we look over to the left side of this chart, we have the low for 2018 at 25.32, and then we have the back test low, which was the first trading day of Q2 at 25.53. If we were to hold that wedge at 25.55, you can see that this sets up a very nice little neat tidy package of levels: 25.32, 25.53, and then 25.55, with everybody and their mother staring down this 25.32 level as it just must be back tested. We must trade all the way down to 25.33, hold and reverse from there. Well, things don't usually work the way that you want them to. They work the way the market has a setup that will hurt the most people. And if everybody is focused on this 25.32 level holding, well, then maybe 25.55 is going to instead hold, and people are going to be hanging on short and getting squeezed out. Okay, so that's what intrigues me the most about the possibility of that falling wedge pattern holding. I will tell you this though, that, you know, like I said, it's just a line on a chart. It's subjective, and it could change based on however you happen to have the line drawn. So it's just there, and if it ends up working out, great. Of course, if we break 25.55, then obviously you got to go to the more obvious trade, which is a full back test of 25.32, which was set back in February. If we were to just simply double down this move that we initially made in the sell-off from 29.41 to 27.10.51, if we were to take that area and double it down, we would make it on down to about 24.80. That would be a spot that would trade if we were to break 25.32. And then we have a whole bunch of unfilled gaps from 2017, the first of which is this gigantic one open from 24.74 on down to 24.61. So those are a couple of targets that I've been working on over in my private account with, you know, talking to people about there. So those would be just some levels that you might want to keep in mind if for some reason the other way that the market wants to hurt people is to completely wash out and break that 25.32 instead of holding it. Okay, so two scenarios there. Either we hold at 25.55 or so, somewhere in there, and make a higher low against the one in April, and therefore have our 3 higher lows for the year, and then boom, take off and run from there. Or maybe we blow right on down through 25.32 and instead go on down here and maybe tap off of 24.80 or 24.61 instead. But the most important thing I think you got to look at in the middle here is whether we can rally back off of any low we make and close above 25.81. 25.81 flat. That is the closing low for the year. And I'll just show that to you real quick. It was back here. It was the day before we made the 2018 low. This is our closing low for the year. Okay? Look at that. Look at that perfect like rectangle of a candle that day too. Opened on the high, closed on the low, and made the closing low for the year that day. What was the open that day? It was 26.85. The low was 25.80, so you had a 105-point move that day. Quite a day there. And what was it about the low in February that held in the first place? It was the 200-day simple moving average. You see that? We poked a line through the 200-day simple moving average, and institutions and funds and people were waiting there to buy that up and take it back up. So now we're trading way down below the 200-day. I don't want to make you dizzy here. Now we're trading way down below the 200-day, and we're in a death cross of it. So the only reason why we would be holding 25.32 at this point is simply to make a higher low. And, you know, in terms of where we are positioned on the year, that we're right at the end of the year. There's performance chasing, there's the Santa rally, there's all that stuff going on. Maybe we do, just for old time's sake, we do hold that low to make it a nice, neat, and tidy exit out of the year. But I would say that as soon as 2018 is over and we hit 2019, there's absolutely no reason whatsoever to stay loyal to 25.32. You know, it's going to mean even less to people than it is probably starting to now. Okay, so the purpose of this video, let's go over it one more time, is trying to figure out scenarios that will screw over the most people. Scenario 1 is a hold at 25.55 to set a nice little set of 3 higher lows. Scenario 2 is that we simply just hold 25.32 and do indeed bounce off of it. And scenario 3 is that we blow through 25.32 and then do not recover 25.81 on a closing basis, and then go on a trip even lower down to our 2400 handle. And there are plenty more gaps down below 24.61. I share those in detail with the people at my private account. You have eyes, you have a daily S&P 500 chart. Go and map them out and know where they are, know your levels, and you will be prepared for when the day comes, and it will come because all gaps eventually do fill. There are gaps that will take us all the way back to 2085. Yes, that's right. There is an unfilled gap from right before the election at 2085. The lowest point we've ever traded since the election is 21.25. So there are just a graveyard full of gaps between there and where we are now. And the very first one that starts out that whole cavalcade of like gaps is 24.61 here that was left in September of 2017. Okay, that's it. I hope you enjoyed this video. And like I said, if you want to follow me at my private account and work together with me over there, just click on the GoFundMe link in my profile, make a donation, and you can read more information about what I try to do and offer over there at the GoFundMe link. Thanks a lot. Have a good rest of your Sunday. See you tomorrow.